The question is called exam, and it's about preparing a group statement of financial position, and it includes so many nice little tricks, some of which you've seen before, maybe some of which you haven't seen before, but that's the kind of nature of exam scenarios. So we've read the question, we've got the group structure sorted out. What I like to do is to sort out where I am with my net assets in these situations. So it's quick to sort out your net assets at acquisition, at year end, and to identify the post. The year end is represented by the equity, and so these three numbers can go in extraordinarily quickly. And there's no need to hang around because these are just being copied from the question, and my share capital doesn't change. So I've just literally, copied this information out here. Now all I'm doing now is looking in the question for the retained earnings. At the date of acquisition they were 30, and for other components of equity at the date of acquisition they were 15. Now is the time to slow down. Now is the time to think what's happening. This figure is 60. Now, strictly speaking, that figure is totally irrelevant. That represents the book value of the net assets at the date of acquisition, and nobody wants to use that. When we calculate goodwill, we want the fair value. Now, I wish the question had absolutely nothing to do with deferred tax. Because if the question had absolutely nothing to do with deferred tax, the fair value of the net assets at the date of acquisition would be 80. Because that's what it says. It says the fair value of the net assets at the date of acquisition was 80, and then it says excluding deferred tax. So it is 80 if I ignore the deferred tax. This will mean that I have a fair value adjustment, and this relates to inventory, and the fair value adjustment is 20. So far, so good. Now, the next thing I'm going to say is either very, very simple or a little bit heavy. But it's all to do with deferred tax. Now, we'll look at deferred tax again, but what you may remember about deferred tax is temporary differences. What you may remember about deferred tax is having a carrying value and having a tax base. And actually, when the carrying value goes up because it's revalued, the increase, the gain, is not subject to necessarily current tax, so you're creating a taxable temporary difference, a deferred tax liability. So this revaluation gain, this fair value adjustment, is a taxable it's what it says in the question. What's the rate of tax? 30%. What's the temporary difference? 20. So what's the deferred tax liability? Fantastic. Anybody who's got 6,000, wherever they put it in their answer, is going to get a mark for sorting out the 6. This 80,000 is the fair value of the net assets excluding the deferred tax liability. So because it's excluding the deferred tax liability, the real answer is 74. So I have another fair value adjustment, which is a deferred tax liability, which is 30% of 20. 30% of 20 is 6, and therefore this is my real deal. This is my real deal as the fair value of the net assets at the date of acquisition. If you calculate goodwill at 80, you might get the wrong impairment loss. But the real goodwill should be based on 74. Now, I'm pausing here for a second. in most exam questions, this fair value adjustment is on land. And if it was on land, the land would still be there at the year end and have to be adjusted. If it was on plant, the plant will still be there at the year end, still have to be adjusted, and should also have to deal with depreciation. Well, there's going to be no depreciation on inventory. Land will still be there 4 years later. Plant will still be there 4 years later, assuming you've got a life of more than 4. What happens to inventory? Inventory is sold. Inventory is turned over. What number am I going to write in there? Correct! I'm going to write in 0. Now, if you wrote in 20, well, you were wrong. If you're going to make a mistake in the exam, make it a quick mistake. Yeah? You know, if you're going to get something wrong, get it wrong quickly. Don't spend 10 minutes and still get it wrong. Right? You just wasted 10 minutes. If you wrote in 20 here, fine, it's not the end of the world. You do normally take the fair value adjustments across, but in this particular question, the asset had been sold. So if there is no asset left, there's no deferred tax liability left. $15, $20, $40, oh dear, then it comes to $75. Let me recap. When I bought the business, the assets were $74. When I bought the business, the assets were $74. Now the assets are $75. So it has been a success, and the success is to the tune of 1. I only own 75% of the sub. Because I only own 75% of the sub, this means effectively 25% of that does not belong to me, and I would allocate that to the NCI in working form. The group gets the other 75%. Unfortunately, we have to distinguish between whether it's profit in retained earnings or whether it's kind of rubbish that's in other components of equity. Other components of equity have gone up by 5. So other components of equity have gone up by 5. So 75% of that goes to other components of equity, which is working 6. Let me think about the logic. If the overall's gone up by 1 and 5 is other, how much is retained earnings? One more time. If the total is 1, this is a trick. If the total is 1, and the total of 1 is made up of partly retained earnings and partly other components of equity, if the other components of equity are 5, how much must retained earnings be? Negative 4? But this is positive 1. This is positive 1, isn't it? That's positive 1, that's positive 5, so we only need negative 4 for everything to tickety-boo sort itself out. Yeah? So, oh dear, there's a heavy silence in the room here. You don't like that, do you? No, you don't like that. Yeah? Look, I don't normally do this, and I might regret doing it now. I will regret doing it now. But I'm going to do it anyway. Nil? That's positive 10. If you've gone from positive 20 to nil, that's negative 20. If you've, that's negative 20. If you've gone from positive to nil, that's negative 20. If you've gone from negative 6 to nil, that's positive 6. So the other way of working out the 4, is 10 minus 20 plus 6. The other way of working out the 4 would be to do it that way. I think just doing a balancing figure is much easier for me. But that's not wrong. I mean, you know, it's not wrong. Right. Technically, I think we've cracked it. Because what we should be able to do now is our goodwill calculation. And there's no reason why we can't get the goodwill calculation correct. Now, when we're calculating goodwill, there are three basic ingredients. When we're calculating goodwill, there are three basic ingredients. The first of which is the fair value of the parent's investment. Do I use 120 or 130? 120. So I pick up the figure of 120. I then have my NCI. Now my NCI is at fair value. And the NCI is at fair value, and that's a number that I'm struggling to find. 30,000. And then I have the fair value of the net assets at the date of acquisition, which is given to me at 74. When NCI is at fair value, goodwill is in full. So when NCI is at fair value, then goodwill is in full. We've got the ingredients to do an impairment review, so I'm assuming there's an impairment loss, and therefore the impairment loss will be split. But I'm getting slightly ahead of myself in a minute. I haven't even calculated the goodwill yet. How much is the goodwill? This is 176, so the goodwill is 76. The information in the question facilitates me doing an impairment review because it talks about the sale of March for 250. It talks about the value in use. It talks about the impairment review, so we ought to do the impairment review. Now, the asset that we're talking about is the cash generating unit, which is the sub. Yeah, we have a cash generating unit. March is regarded as a cash generating unit. So we need to know our year-end net assets, and we need to know our full goodwill. If you've got the numbers wrong, it doesn't matter because you're putting the wrong numbers into the right process. And your process is being marked. Method marking, own figure rule. Method marking, own figure rule. So my year-end net assets, I believe, are 75. Some of you may have had a bigger number if you've taken the 20 and the 6. Doesn't matter, you're penalised once, not twice. So the carrying value of your net assets is 75. What's the full goodwill? It doesn't need grossing up because NCI is at fair value, so your full goodwill is 76, and therefore you've got 151. Now an asset is impaired when the carrying value exceeds the recoverable amount. If you wanted to sell, you would sell it for 250. If you wanted to keep it, you'd extract a value of 400. Do we take the higher or the lower? The recoverable amount is the higher of the fair value less cost of sale and the value in use. How much is your impairment loss? How much is your impairment loss? We've gone to all this time and trouble and effort of calculating the impairment loss. How much is the impairment loss? Thank you. Yeah. Do you remember me getting on my knees? Do you remember me asking you never ever to say impairment gain? Yeah? So, we go to the time and trouble of doing an impairment review, and there's no loss. Fair enough. I mean, it's a little bit unsettling if you're in the exam on your own, but this thing sometimes happens. So you've just got to say to yourself, no. So actually, even if you had miscalculated the net assets, and you still would have should have ended up with the right answer. Yeah. So right, we have no impairment loss, which means life is a little bit easier. Let me do some posting. So I've now got my NCI. I've got the opening balance of my NCI of March, which is 74. I'm going to allocate to them the share of the post-act. And the share of the post-act that I'm allocating, is 25% of 1,000. Have I picked up the wrong number? Oh, I picked up the fair value of the net assets, haven't I? Sorry. I should. There we are. It's happened already. I was warning it was going to happen. Yeah? So that number there is 30,000. Thank you for the correction. So the fair value, so the opening balance of the NCI is 30. Now, what's really important is that you say plus share post-act, and you show 25% of 1,000. This is reference to working 2. It doesn't matter if the 1,000 is wrong, you will still get a mark for giving the share of the NCI, for giving the NCI their share of their post-act. You must clearly write this, 25%. Don't just put numbers down, 25%. It's plus the share of the post-act. Now, there is no impairment loss, but there is a control-to-control story coming. Leave space, retained earnings is the parent company, and the parent company is 70, and then you've got to bring the share of the post-act, and the share of the post-act that you're bringing is 75%, and it's bizarrely negative, I seem to recall. We had a lot of fuss about. 75% of 4 is 3. And then we've got in working 6 other components of equity, and we start off with that of the parent company, which is 40, and then we will add from working 2 the share of the post-act, and the share of the post-act is 75%. I seem to remember it's 5. But I'm just remembering that. There it is, 75% of 5. So 75% of 5 is how much? $375. Right, that was a little burst of energy because that was just simply posting. What do we do next? Because I suspect there's quite a few of you who didn't get this far. And I need to slow down out of sort of, what are we doing next? What are we going to do next? We've done the impairment review. I suppose I could do the balance sheet left, but there's a control-to-control relationship going on, isn't there? So we'll call it working 7, and there is a control-to-control. Now, I've got to be very careful here that I don't write down too much or anything. I am selling 10%. I'm selling 10%. I have control here. I still have control here. So this is an increase in the NCI. This is going to result in a difference. We are selling them a slice. How much is the cash? 6. Cash in or cash out? Cash in. This is the nature of proceeds. This is a credit. Now there's a very strange